Good morning to all the participants on the call, and thanks for joining this Q2FY22 earnings call for Elecon Engineering. Please note that we have mailed out the results and the presentation, and it has been uploaded on the stock exchange. You can also find it on our website. In case you have not received the same, you can write to us and we'll be happy to send this over to you. Before we proceed to the call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risk that could cause a future result, performance, or achievement to differ significantly from what is expressed or implied by such forward-looking statements. To take us through the results of this quarter and answer your questions, we have with us the management of Elecon Engineering, represented by Mr. Prayasvin Patel, CMD, Mr. Kamlesh Shah, Group CFO, and Mr. Narasimhan Raghunathan, CFO. Mr. Prayasvin Patel will give you a brief overview of the quarter gone past, and then we'll open the floor to Q&A session. With that said, I would now hand over the call to Mr. Prayasvin Patel. Over to you, sir. Sir, you need to unmute your line.
Thank you. Good morning, everyone. A very warm welcome to Elecon's Q2 FY2022 conference call. We hope that you enjoyed the festival of Diwali, and we wish you a very happy and a prosperous new year. Also, we hope that you have been taking abundant precaution in tackling the pandemic as more and more activities are open in the days ahead. Our company has declared the results for the half year ended September 2021, which is available on our website. Discussing the result at the standalone level, we have had a relatively healthy quarter with both gear and MHE business reporting good performance. During the quarter, the total operating income increased by 14.7% year-on-year to rupees 235.2 crores from 205 crores in the corresponding quarter of the previous year. The EBITDA on absolute basis stood at 50.9 crores as compared to 53.3 crores during the corresponding period of the previous year. This translates to EBITDA margin of 21.7% in Q2 FY22 as compared to 26% in Q2 FY21. The decline in margins was due to the change in product mix. We closed this quarter with a PAT of rupees 23.1 crores as compared to 20.2 crores during the corresponding period of the previous year, an increase of 14.7%. During the quarter, we have reduced the debt by approximately 40 crores, and we have taken various steps to substitute high-cost debt with low-cost debt, and we continue to pursue the same, which will help us in reducing the interest cost during the rest of the year. Standalone half-year results. The total operating income increased by 54.1% year-on-year to rupees 454.5 crores for H1 FY22. The EBITDA increased by 107.2% year-on-year to rupees 101 crores as compared to 48.7 crores during the corresponding period of the previous year. This translates to EBITDA margin of 22.2% in H1 FY22 as compared to 16.5% in H1 FY21. The PAT increase to rupees 46.2 crores in H1 FY22 as compared to 1.4 crores during the corresponding period of the previous year. Coming to the consolidated financials of the Q2 FY22, the operating revenues increased by 17.7% to rupees 310.4 crores in Q2 FY22 as compared to rupees 263.7 crores in Q2 FY21. EBITDA increased by 13.4% to rupees 66.7 crores as compared to 58.8 crores in Q2 FY21. This translates to EBITDA margin of 21.5% in Q2 FY22 as compared to 22.3% in Q2 FY21. The net profit increased by 61.1% to 35.4 crores as compared to 22 crores in Q2 FY21. Consolidated half-year results. The operating income increased by 51.3% year-on-year to rupees 602.9 crores for H1 FY22. EBITDA increased by 123.6% year-on-year to rupees 125.5 crores as compared to 56.1 crores during the corresponding period of the previous year. This translates to EBITDA margin of 20.8% in H1 FY22 as compared to 14.1% in H1 FY21. The PAT increased to 62.6 crores in H1 FY22 as compared to 1.3 crores during the corresponding period of the previous year. Order book position. Overall, we have had a relatively healthy performance in the quarter, largely driven by traction in the gear business as a whole. We are seeing a gradual pickup in demand on the back of recovery in economy, and we saw a ramp up in the order booking with order book position as of October 2021 worth 340 crores in gear business and orders worth 72 crores in the material handling business. For our overseas subsidiaries, we have been witnessing good improvement in our market reach in the Americas region of USA, Canada, and Latin America, based on which the revenue growth is seen. For entities in Europe, clarity in Brexit is helping us, and despite the impact of the pandemic, we continue to be profitable. We are also taking various steps as much as possible to overcome logistic constraints due to pandemic. Total order book position of Elecon Group stands at 514 crores. Based on our change in strategy in US operations, we are witnessing positive momentum in the order intake and revenue, and we expect significant improvement in the overall performance in the US business in the coming quarters. Focus on debt reduction. Similar to debt reduction efforts we are taking in India, we are also in the process of reducing the external debts of our overseas business. We are in the process of becoming debt-free in our overseas entities by the end of next month. Future outlook and strategy. We continue to focus on strategies to create long-term value for our shareholders. The MHE division is now becoming more resilient as we are in the process to complete the punch list item as a part of the COD process to hand over our legacy projects and are now focusing more on product business in the MHE division. We continue to streamline existing operations, which has led to improvement in EBITDA margins and overall profitability. We will continue to strengthen our balance sheet and reduce our debt and liabilities in the coming quarter. We are confident that the performance will continue to improve in the future, looking at the revival of the demand scenario and on the back of strong execution and favorable product mix. Thank you all. We will be happy to address your specific queries about the business going forward.
Thank you. Before we pass on to the queue, we'll take one question from the chat board. Prashant asks, I would like to know that in the material handling projects, are we expecting any write-off or loss in future? Have we taken any write-off in the past? What is our pending execution in this segment?
Narasimhan, would you like to answer this?
Yeah. We are in the stage where these projects, whatever we have taken, we are going to close it in this year. And raising out of that, the retention money and other thing will be claimable. So there is a process by which after completion of various activities, various milestones and certificates have to be obtained, then these claims have to be lodged. We will be looking forward to receive those claims, and we don't expect a loss from those claims.
Thank you. We will take the next question from Pritesh Chedda. Request you to unmute and please state your name and institution name.
Yeah, thank you for the opportunity. So this is Pritesh from Lucky Investments. Sir, a question on on your opening comments about repaying a substantial part of the debt by next year. So does that include a lot of retention money to be received as your assumption to repay the debt, or you think that naturally from the cash flows of your business you'll be able to repay the debt? Within that, my second question is, you were referring to substantial reduction in interest costs by virtue of repricing of the debt. If you could help us understand what do you think should be the debt numbers for 22 and 23, and what should be the interest cost expense for 22 and 23? These are my two questions, and I have one more question on gearbox. I will come back on that.
Okay. Let me start off, Narasimhan, and then you take it over halfway through. Pritesh, thank you for taking so much of interest in our company. First of all, let me tell you one thing, that our generation has been so positive that we have been able to reduce substantial part of our debt. And apart from this, we are right now thinking very conservatively that we will recover zero amount of money from the material handling projects which are going on. Even if we do that, then also our positive generations which are happening because of the high turnover in gear, the high profitability, as well as reduction in the overall debt and the interest cost itself is giving us enough accruals whereby we should be able to become debt-free very soon. Okay. With this, Narasimhan will give you the figures. Okay, going ahead. Narasimhan.
Yeah, Pritesh. So this debt reduction will happen from both the accruals which will happen based on the business performance, as well as the collections which we expect from the material handling division. It is a combination of the both. In terms of the amount, you would see that approximately on an average in a quarter, we are reducing the debt by around 30 to 40 crores. So we should same line. And as what in CMD speech it has been covered, we would like to become debt free at the consolidated level by 2023.
Okay. And what is the retention money current balance sheet which needs to be recovered, so that would be your additional kicker, right?
Around 100 crores.
Okay. My question now is on gear motor gearbox side of the business. From your opening comments, you were mentioning about better activity in the economy, and you're seeing inflows. So just from the gear motor gearbox side, when you look at this order backlog, are you seeing now growth in revenues will start building up? Because our business and, that for matter, a lot of capital good equipment business have been stagnant for, quite some years. So are you seeing a situation where you get into a phase of multi-quarter, revenue growth rates? And from the margin perspective side, we do a fairly, 18 to 20% EBIT margin, which also has benefits from your, slightly profitable export orders as well. So if you could give some comment on the margin direction as well for the gear motor gearbox alongside the growth direction, with whatever data points that you are seeing, building up for the business.
Yes. Let me start off by saying that, first of all, the Indian economy has taken a substantial traction, which means the capex cycle, especially in the core industries, the infrastructure building industries like cement, steel, etc., have all started catching momentum, which is giving us a healthy inflow of orders. And this also includes businesses like sugar, which is also catching a good traction. Recently, we got one of the largest orders very recently in the last 2 or 3 years from the sugar business. So overall, the Indian environment seems to be extremely healthy. It is also backed up by good inflow of orders coming in from export, especially because of the fact that, as mentioned in my speech, Brexit has now, probably we have seen the past of Brexit. Now UK is on the verge of getting over the effects of Brexit. In United States, because of the huge pumping in by the government money during the COVID situation, we are seeing a good amount of traction even in America, that is USA, as well as in South America. So there are healthy orders coming in from there also. So overall, everything seems positive, and that is showing in the figures also. Okay. We are expected that our export sales over a period of time will improve further, because there are a lot of actions that we are taking to see to it that we penetrate further deeper into the market and get more orders. Okay. As long as our after sales business is concerned, that is also showing a healthy traction. So all in all, things seem to be very, very positive.
So, sir, so from your comment, can we conclude that we are actually seeing a multi-quarter high growth rates in the gear motor gearbox side of the business from the revenue side, revenue perspective?
Definitely, yes.
Okay. And from the margin perspective, you didn't give a comment?
Margins perspective, we are watching our margins very, very carefully, because since the order inflow is very healthy, we don't compromise on the margins as long as sales are concerned, and that is reflecting in the performance of the company.
And lastly, on the asset utilization side, in the gear motor gearbox, what capacity utilization you would be running at, and will you need any capex?
That is an interesting question. As long as capacities are concerned, we don't need any additional capex, because today also, while we are talking, we are hardly operating at about 60% utilization of capacity. With subcontracting that can be done, it can be, we can increase our turnover to a substantial extent if required. As long as replacement of machinery is concerned, yes, because we have not done a capex for a long period of time. Machines which have got outdated, machines that have lost the accuracies, and machines which have become obsolete, all those would have to be replaced. Okay, so there is a definite planning that the company is going through, okay, of what would be the requirement of capex, what needs to be replaced, when and how. But we will make sure that there is not a substantial debt that we will take going forward to replace this units.
Thank you. Ritesh, request you to come.
Yeah. Thank you very much, sir. Thank you.
So we'll take the next question from Vishal Prasad. Request you to state your name of your institution, please.
Hi, good morning. This is Vishal from VP Capital. I have few questions, sir. So 7 years back, we used to talk about us trying to get into windmill machines, supplying gears to them. But I don't see the discussions anymore. So what has happened there? If you could help me understand.
Sure. Vishal, windmill business, our machinery and infrastructure that we had put in about almost 10 years ago, is capable of not only doing windmill gearboxes, but also bevel planetary for cement, for planetary gearboxes for sugar, as well as for various other industries. So the machinery being common, we were trying to pursue all the areas. What we have found with windmills is, yes, if you join hands with the very large players, it gives you a consistent quantity of gearboxes for the windmill, but it is a very highly risk-oriented business, because if the quantities of windmills to be installed reduces, you land up with substantial amount of inventory, because the entire process is driven by numbers. So, as well as there are also very high level of risk in failures, okay, and maintenance. And that is the reason why we have taken a back step, because what we believe is that if we can generate enough margins in the other business, it is better to avoid this business to a large extent. That doesn't mean that we will completely be out of it, but we will be treading into this very carefully and cautiously.
Sure. So second question is on our defense side of business. I think it's been 6 to 7 years when we got the large order from Navy. And after that, I might be wrong, but I haven't seen any traction in the business. We getting new business from Navy or defense side. So what has happened there? Is there something we are lacking, or there's no order coming from them?
Before we get into this, what I would like to show you is, in the background, the gearbox that you see behind my back is the gearbox that we have supplied to the Indian Navy for their aircraft carrier ship, which has been just launched by Cochin Shipyard. This is the first attempt by Indian Navy to make 100% indigenous ship, which is an aircraft carrier. And we are all proud that we have been able to supply these units, and which have been working extremely well. They have been taking trials, sea trials, and the performance has been extremely good. So now coming to your question, yes, it's been almost, I don't remember exactly how many years, but about almost 6-7 years since we last got order for Indian Navy. Now, normally if you look at the Indian Navy cycle, it comes in spurts. It is not that we have lost any single order. It is just that the Indian Navy orders the ships, not all of them at the same time, which means once an entire project gets over, then they go back and then order a different project, whereby they build ships in quantities of 3, 5, 7, etc. So once this project gets over, then they will go in for something which is required by them in quantity. So as I told you, we have not lost a single order. On the other hand, we are aggressively pursuing the new projects which are coming in. And hopefully we will be successful in getting those orders as and when Indian Navy releases.
Okay, so last question, sir, from my side. If I look at you and the organization, generally we are very considerate about risk. I mean, we think about risk before getting into anything. But when I look at the turnkey MHE business, I mean, we have not been very successful there. So could you share your thought process on why we got into this business and any learnings that we have from whatever happened there? That would be great.
See, the company started with material handling. And therefore, if you dissect the name Elecon, it means elevators and conveyors. ELE stands for elevators and CON stands for conveyors. Elevators are not the lift elevators, they are bucket elevators. The ones that you find them in cement plants and the likes, fertilizer plants. Now, we have been in material handling for many number of years. And material handling business always goes through a cycle where there is a boom period and then there is a recessionary trend which comes in. Okay. Which has also happened recently. But what normally happens is once you get into recession, you normally don't go pursuing projects. The reason is everyone who is in this business is chasing the same order. It is like saying that there is hardly 10% business and all the companies are pursuing that 10% rather than, trying to avoid taking orders. So what happens is the price levels go to such low extent that in projects you make huge losses, and which is the reason why we have kept ourselves away from projects in the recent times. And we are trying to sell products because over the last 30-40 years, the entire material handling industry in India relies on Elecon products. There is practically no single power plant where Elecon products are not working. And if you meet the employees, they will tell you that the Elecon products are robust and they keep on working for years on years on years. And which is the reason why we have decided that under the present circumstances, it is better to only sell products. The other advantage of selling products is that you invoice the products as and when they leave the company as finished goods and you recover your money fast. In projects, your money gets retained by the customer and it takes years to collect them back. So it is advantageous right now under the present circumstances to pursue products rather than projects. And which is what we have been doing even in the past, because in the last 40 years, we have gone through this cycle many a times. And every time there is a recession, you start only selling products and stay away from projects.
Thank you, sir.
Thank you. We have the next question from Ankit Babel. Please state the name of your institution before beginning the question.
Yes, sir. Good morning. This is Ankit Babel here from Shipcom Ventures. So my first question is, during the quarter and in the first half, what was the contribution from the Navy order in your revenue?
Contribution, as long as turnover was concerned, that we can give you. Narasimhan, I think we have invoiced approximately about 100 odd crores, if I'm not mistaken. Can you give the exact figures?
So the invoicing is one aspect, but since it's an revenue recognition, it is around adjustments. Invoicing up to date is 380 crores.
No, my question is in this quarter and first half of this year particular. Approximate figure will also work.
It's around 55 crores.
Okay, and what is the unexecuted order book remaining in that segment of, I mean the Navy order?
70 crores. Around 70
plus.
So that 70 crores you expect to, complete by the second half of this year?
It can spill over to the first quarter of next year.
Okay. So my actually my question was, so this year around 100 crores of revenue would be contributed by the Navy order approximately. So Patelji, my question is to you that suppose if we end the year at around, say suppose 1050 crores in your gear business revenue at a console level, in that 100 crores would be from the Navy order, which would not be there in next year. So on a base of 1050 crores approx, what kind of growth can you do in the gear business on a consolidated basis next year, assuming that there is no contribution from the Navy order next year?
There are two aspects of this. One is the top line and the bottom line going forward. So we have been evaluating this and knowing fully well that the next year, since there is no Navy order which has come in up till now, we will have a shortfall of 100 crores from the marine business. Considering that, we have tried to see to it that whether we can enhance our business in the export area, and we are confident that at least 30 to 40% additional revenues we can expect from export in the next coming year. That is number one. Number two is, as long as bottom line is concerned, we have evaluated and we believe that the bottom line we will be able to sustain in spite of the fact that we would not be having the Navy business in the next year.
So 30-40% on what base of exports?
No, 30-40% of the 100 crores. That means 30 to 40 crores additional business we expect from the export business.
Okay. So is it fair to assume that you might actually report flattish revenue growth next year in the gear business at console level?
Top line, yes.
Okay. And my second question is that, again at the consolidated level of gear business, last year you had reported around 22% EBIT level margin at a console level. So where do you see these margins in this year and next year?
As long as margins are concerned, we expect the margins to be maintained even in the next year, because there is going to be a substantial debt reduction, okay, as well as restructuring of our loans will give us the additional revenue that we were getting from the Navy or Marine.
So my question was at the EBIT level. Interest costs, I understand, will come down, but before interest, your margins were around 22% last year. At console level?
Those would be maintained.
Okay. And sir, in your last question is on your material handling business. Where do you see the what kind of revenue and profitability you see next year?
See, revenues, as far as we are concerned, as long as the top line is concerned, we have been going very, very conservatively and very cautiously. We are not taking orders where we don't get the type of margins that we are looking for. So the top line would definitely be hit. It would be in the similar range as what we are doing today. Okay, it may go up by 20% to the max, but we wanted to see to it that we maintain the bottom line, which we are very confident that we will be able to.
So maintain in the sense the 6 crore EBIT level profitability run rate on a quarterly basis can be sustained from here on.
No, it will further improve because, as I told you, that the interest cost on the material handling business will go down substantially.
No, sorry, sir, but again, my question was at the EBIT level.
At the EBIT level, yes, we will maintain the margins what we have today or improve upon them to some extent.
Okay, sir. That's it from my side. Thank you, sir.
Thank you.
Thank you. We have the next question from Janam. Request you to state your name and your institution name before beginning.
Yeah, hi, this is Manan here from Maniki Securities. Sir, my question was on the order book. So sequentially, there has been a drop in our order book in the gear division as well as the MHE division. And also we mentioned that a group order book at around 5 and 4 crores versus, so there's differential of 100 crore of the order book. How does it benefit Elecon Engineering? And secondly, if you can provide a breakup between the gear order book between our catalog products and non-catalog products.
See, under the present circumstances, not having a large backlog of orders is working to our advantage. On one hand, it is not reducing our turnover. On the other hand, because the prices have become extremely volatile, steel prices have increased, copper prices, all metals are going through a substantial. And therefore, what is happening is it is better not to have a large backlog of orders because this volatility, one doesn't know where it is going to lead to. Okay? Because as you know, the international environment is quite volatile once again. So considering that fact, we believe that going forward, we want to trade very cautiously and see to it that we maintain our margins in the orders that we receive, especially in gear, because the cycle of manufacturing is very short.
Okay, and catalog and non-catalog bifurcation of the order book?
Narasimhan, would you be able to give that answer?
And also on the differential of 100 crore between the Elecon Group order book and the company order book, how does that benefit us, if at all in any way?
We will be having a breakup of the catalog and non-catalog. It's a consolidated breakup. And in terms of the differential, what is the question? Can you clarify?
Yeah, so we've mentioned that our gear order book is around 340 odd crores, MHE is 72 crores, which totals to around 412 crores. And we mentioned that the Elecon Group order book is around 514 crores. So the difference over here is around 102 crores.
This group, we mean this, it is the Elecon India as well as the overseas. Nothing to do with the other group companies.
Okay, got it. Now my next question was on the retention money, and so in our previous call we mentioned that the retention money was around 250 odd crores, and I think earlier in this call you mentioned that the current retention money is around 100 odd crores. So just wanted to confirm if there has been a release of 150 odd crores during the quarter. And also we mentioned that by end of Q3, we will be net debt free. So on that basis, are we expecting 100 odd crores of free cash flows in Q3?
Jainam, I just correct. So our net debt free, it will be my overseas entities, which will be net debt free before the Q3 of this financial year.
Could you just quantify what is the net debt, what is the debt at the overseas subsidiaries?
Presently, our overseas subsidiary is having the debt of nearly 40 crore in terms of Indian rupees, which we are going to settle before the end of this Q3.
Okay. And regarding the retention money, because last quarter we mentioned it around 250 crores, and I think earlier in the call you mentioned it as 100 crores.
The last time we would have mentioned both the gear and the metal handling put together.
Okay.
So that will be the reason.
Okay, so the current retention money of 100 crores is only for the MHE division.
Yeah.
Okay. Okay. And okay, thank you. That will be all from my side.
Thank you. We have the next question from Jaki Nasir. Please go ahead.
Yeah, can you hear me?
Yes, we can.
Frozen Bhai, first of all, congrats to you and Team Elecon for the fabulous performance this quarter. Sir, there are two questions I have. We are currently logging at 60% of our capacity utilization. And in one of the last calls, you are mentioning that you all are looking at maybe a different kind of usage for this additional capacity or space. Have you crystallized anything on that end, sir?
Yes, we have been able to crystallize. That is not the point. The point is that we are looking for more orders from that area, where we are doing some trials with the railway business as well as other kinds of business, where you have, as we term it, as loose gears. See, today our business consists of gears which are put in a gear box, which is the casing. Loose gears means where you have gear components which certain industries require, where you only sell the gear components, especially, let's say, railways. So they buy only gear components. So we are looking at gear business from the railway sector as well as others, where we can supply loose gears to further enhance our capacity utilization. But that is constantly on. We have to do various trials. We have to go through an entire cycle, which quite often takes a long period of time.
But in your opinion, sir, how large can this business be?
The total potential would be around about 50 odd crores
per year. Fantastic, sir. And sir, see, right now our debt levels are around maybe a little more than 200 crores. I guess Elecon would close its long-term borrowing, but what level of working capital debt would you be comfortable in maintaining, sir, in terms of maybe fresh expansion or capacity utilization?
See, our intention, first of all, is to become debt-free. Whether it is long-term loans or whether it is working capital. Okay, so the company will work towards that. And as and when it requires any kind of infusion of money, it will probably go to the market to get some. Okay, by other means except for taking loans. Because there is a capex cycle, there could be acquisitions, there could be a whole lot of ways that one would expand and grow. Okay, so but the intention would be to remain debt-free now in the future, because we have seen a lot of ups and downs in the economic cycle, and we've had some tough times, and we would like to see to it that we don't go through the same mistakes that we have done in the past.
Thank you, sir. Sir, one question general about the engineering industry, sir. I mean, past 6-8 months, I think past 3 quarters, we've seen a pretty volatile movement in the steel prices. How easy has this been to pass on to the consumer, sir? And what do you foresee going ahead from now about these prices and the effect on general products of the engineering industry?
See, luckily, if you look at our business especially, which consists of material handling and gear, if we were doing projects, it would have been a very bad situation, because projects where normally the prices are fixed or even the escalations, if there are there with the escalation formulas, you are not able to realize the complete increase or pass on the complete increase to the customer. So luckily, since we have not taken any project orders, we have not faced those problems. As long as gears are concerned, yes, it does affect us, but if we are careful, then you can pass on the increases to your clients, which we have been able to do successfully this time.
Thanks a lot, sir, and best wishes for the...
Thank you.
Thank you. We have the next question from Sunil Kotari. Please go ahead.
Thank you very much. Good morning, everybody. Congratulations to team for such a good performance during not just this quarter, but if I look at during last 3-4 years, the way we are changing is really commendable. Looking at reducing losses from material handling, increasing profitability in transmission division, increasing profitability in external market outside our Indian territory. Really commendable job.
Thank you. Thank you very much.
My question is, looking at the profitability improvement, India is not yet that recovered. The capex cycle is improving. So, what are the reasons you will like to ascribe to this successful and very high profitability of our transmission division? I think one apparently looks to be exports market, but looking at your last 10-year effort, our exports from India is not that sizable. So how do you look at this opportunity during next 3-5 years? What type of size would you like to reach, maybe in terms of numbers or whatever you can tell about domestic, our ability to penetrate international market?
You are right, Sunil bhai. I would put it this way that we had ventured into areas where we had expected that we would get a large sum of business from the export, and which is the reason why we had acquired these companies abroad. But we had to reorient ourselves to this kind of marketing, as well as products which were slightly different from what the companies were selling in the past. Plus, we had a huge setback in United States when we started off. We started off very enthusiastically, hoping that we would be able to sell products all over the country in United States. We made losses in it. We had to retract ourselves, change our strategy completely. We re-entered the market with a different strategy, and now we have been successful. So it's been a big learning lesson, which has consumed a lot of time. But going forward, we are expected to have very positive results. Okay. I believe that we can see the next few steps ahead, which are very positive. Okay. And if you look year on year, our sales in United States has been increasing, and so has it been even in Europe. I still believe that there is a lot to extract from those markets. We have just, seen just the tip of the iceberg. Okay, so there is a lot that can be done, and going forward, we would be keen to improvise and change our strategies if required to further pursue those markets and get more business. Okay, but I can tell you one thing, that our teams which we have put in, especially in United States, are very dedicated and committed, and they have a lot of enthusiasm that they will be able to do much better even in the future.
Great, sir. So, Prasanbhai, can we have our aim or objective to reach 500 crore revenue from exports only from the India, maybe over the next 3 years, 5 years, 7 years? Can those type of objectives can we keep?
Yes, once we stabilize with our margins and profitability and with our performance, the future would be that we go and acquire more companies and do consolidation, especially in Europe, and maybe if required even in the US. Okay, where you buy small companies, put them all together. Okay, so that your costs, you are able to, in the consolidation, you are able to reduce your costs by consolidation. Look for additional markets through these companies and grow, which according to me has great potential. We were not able to do that in the past because of the financial problems that we went through. But I believe that is the future. And that is what we need to pursue, which will help us grow our domestic business in a big way, because we will be able to manufacture out here and export.
Great, sir. Sir, my last question is, because of your so many years of experience and what many up downs you have seen with I think guidance of Bhanubhai, the way he created this empire, what is your thought process for next 3-5 years? What will be one? You will definitely not going to do any very high debt organization. What you would like to do next 3-5 years, which help us to keep this Elecon brand and Elecon organization for next 30, 40 years, carry on this ability and our the way we create our brand and ability. So, what's your objective over the next 3-4 years? Maybe some consolidation of some small units of yours, increasing your stake. Anything you would like to share some thoughts on these things?
As I told you, in years, the way to go in the future would be more acquisitions, especially in Europe or in the Western nations, especially Americas. Okay, that is one. The future also because the material handling business is where we have taken a back seat right now as long as projects are concerned. We have huge facilities which are available to us, and we need to look at new products that we can look into in other kinds of businesses except material handling. We need to diversify into that. Right now, the focus of the management is to see to it that we get debt free. The second aspect of the business would be how to utilize the facilities that we have in material handling to do other kinds of business. And I believe that there is a good potential in the construction business, which means in road building and in bridges. So equipments that are required to manufacture roads, as well as to build roads, as well as to build bridges, is what we should look at seriously and see to it that we get into that, where we can supply these equipments to the builders. And I believe that the way India is progressing on that side, there would be no recession coming in, at least for a couple of years, which would give us a relative time to stabilize in that business.
Great, sir. Wish you good luck and thanks a lot, and welcome back, Suresh bhai. Thanks a lot.
Thank you.
Thank you. We'll take a question from the chat board. It says, why do you expect nil growth in top line for gearboxes business next year? Even assuming 100 crore goes out, given the conducive environment in all your geographies, shouldn't you be able to make up for it and even grow? Or do we mean similar top line in FY23 is the very minimum we can commit?
See, the Indian market is something that should grow, but today it is very difficult to say anything because of the COVID situation. And that is the situation world over. Today, COVID is a wave which comes and goes and again comes back. So it is very difficult to predict what the future will be. But considering the fact that we have been conservative, considering the fact that though COVID had hit India as well as our area very badly in the beginning of the year, we were still able to operate and generate a turnover and meet with our targets. So considering that we are very conservative, that is why we are saying that we will be able to maintain our figures. And we are expecting that in the export, we would be able to get at least a 20 to 30% jump. Okay. And we will be able to maintain our bottom lines and improve upon it. So those are the very conservative figures that we are trying to tell you. Again, hoping that COVID would not turn out to be very nasty.
Thank you. There's another question which asks, can you put some light on R&D expenditure going right now or expected to be incurred in next financial year, and any positive impact you can have in exports due to current shortage of electricity in China? This is from Chirag Jain.
R&D expenses, according to me, in our company would be almost 2 to 3% on a continuous year-on-year basis. We continue to develop new models, new applications on a continuous basis, and I can very proudly say that in the Indian environment, there are very few companies who are doing the kind of R&D that we are. And we continue to do so. And it is part of our DNA, which means on a continuous basis, we are pursuing things that has got a good potential to go about and get us more business in the near future. Okay. As far as the second half of the question, I don't recollect. Apart from R&D, there was something else that.
Yeah. So, and any positive impact you can have in exports due to current shortage of electricity in China?
Unfortunately, we are not deeply penetrated into China. We have very negligible business in China. So we've not been able to pursue that aspect. However, the Far Eastern offices that we have are aggressively trying, but I'm not too sure how successful we will be. Because China is a very, very tricky market to penetrate.
Thank you. We'll take the last question from Vishal Prasad. Please go ahead.
Hi, sir. A few more questions from my side. So you talked about our US business and you talked about we need to look at smaller companies and probably will take over. So, and you also mentioned that how we have put a new team together. So could you talk about the challenges that we face in US market that we have to overcome through acquisitions?
See, the challenges that one would face, first of all, the biggest challenge we face in the beginning is the cultural gap that we have between the two countries. Okay, though you can say that the whole world has become international and, things are, Today, it doesn't matter where you are, the Western and the international culture is more or less the same. But the people are different. Okay. And we believe that when we talk to them also, we feel the difference. Their understanding of what our requirements are and what they do are quite often different. We have found that it is better that we inject a few people of our company into that organization to see to it that the transition from what they were to what we want them to be becomes relatively simple. Okay. So that is a big challenge. A cultural change is a very big challenge. And quite often the expectation that we have vis-a-vis what they feel they need to do are also quite different. So we've learned a lot as long as that is concerned. Retaining people right now is one of the biggest challenges that we are finding, especially in Europe and United States, because of the government giving a substantial compensation. We find that people are jumping jobs very fast.
Right, sir. So my question was more from acquisition perspective. You mentioned that we would have to look at acquisitions. So is there a gap in our capability that we are trying to address through acquisitions?
No, there is. See, the gap is reaching out to the different markets. What we found out is that when you try to export from here, the conversation happens through emails and there's exchange of data. But when people from their own country go and meet them and talk to them, and quite often those clients, if they have met them before and have transacted business with them, their sense of comfort is quite high. And that helps them bag more business. So if you acquire companies who operate locally, and if they go and meet the customers in that area, the chances of success become extremely high, which is the reason why you need to do this.
Sure. So last question is, in the past we have talked about opportunities in railways. So do we still see opportunities there, and how large that would be?
We have found that the domestic market in railway is very, very competitive and there is cutthroat competition. The margins are not healthy enough for us to penetrate into that area. But railway business is a huge business internationally. So one needs to penetrate into that area, and we are looking at the European market, whether we can penetrate into that market with some kind of alliance.
Okay. And is there anything happening on pipe conveyor side?
No. See, pipe conveyors, as I told you, would become a project. And therefore, all we try to do is people who get orders for pipe conveyors, we try to supply them products.
Okay. Sir, you mentioned about MHE business where we are trying to get into manufacturing equipments for this construction and all. So, could you talk about the products that we would be manufacturing there? Have we finalized anything?
Right now, nothing has been finalized. We see a good potential in that area. One needs to explore and evaluate everything before jumping. So it is still in the very introductory stage.
Okay. Thank you, sir.
Exploratory stage.
We'll take the last question from Karthik Keyan. Please state your name of your institution and keep your questions. Try to limit it to one or two.
Sure, I will do that. Yeah, thank you very much, sir, and good afternoon. Wanted to understand the prospects in the US business slightly better, both for catalog products as well as custom-built products. And say if you had to give us some kind of a goalpost for FY24, separately for different regions, Europe separately and US separately, some thoughts will be interesting, sir.
We believe that we should be able to grow by at least 25 to 40% in the US market year on year. Okay. The reason is that as I told you, we have just reached the tip of the iceberg. Okay. There is a huge potential which resides out there. And there's a huge requirement because it's a very large country, highly industrialized, and the potential is very high.
But I was also asking for some thoughts on custom built versus standardized products.
The requirements are both out there. But I would say that custom built would have better prospects.
Okay.
Because the competition would be far less,
right,
and we would find ourselves to be more competitive.
In your assessment, what would be your primary competitive advantage be, sir? Assuming, cost would be the primary driver in any case for somebody from India, but what else would you say is your primary advantage?
The primary advantage is that our product range is one of the largest you can find anywhere in the world. Okay, we make from pin to an elephant, as long as gears are concerned. So the advantage when you go to a client is that everything that he requires, he can get it from one source. That is one. Second thing is that all our product lines that we have a tremendous amount of experience in those areas, because in all our product lines in India, we are more or less number one, which means we have the highest sale in the country.
Sure.
So that has given us a vast amount of experience. So for any applications, we are able to find solutions for the client. And therefore, the US clients become highly impressive that, yes, we've understood the problem and we've given a solution which suits them. And because we've given those solutions in the past of a similar kind, they feel fairly confident about it.
Is there a risk at all that local manufacturing would be mandated in the US at any point in time, sir?
No, not at all.
Not at all. Secondly, sir, and I'll stop myself after this, which is you spoke about certain front-end acquisitions, I assume, in Europe. Right?
Yes.
Would these be, say, small tickets like $1 million and $2 million, or would it be larger in size? Just trying to think about, what kind of capital commitments would you have to make for these acquisitions? Would these be small acquisitions or largish acquisitions? So I'm just trying to understand some scale perspective.
They won't be $1 million or $2 million because you can't buy a company in $1 million or $2 million. But I would say it would be around about a 20 million kind of thing. So about 100, 200 crore company or a 300 crore company.
And what do you get for that, sir, in return? As in,
see, first of all, you get an access to that market, which is the most important thing. And you get manpower, marketing manpower, as well as you get an advantage that you would be able to transfer a lot of the manufacturing to India.
And what would the current scale of operations for such a valuation be like?
Difficult to say.
Right.
It would depend on case-to-case basis.
Right. And are there technology gaps that you would also want to fill with this, or would it be largely front-end focused?
No, you should be proud to know that there are no technological gaps within Elecon. Sure. We have over a period of time, because we are continuously doing R&D, we are continuously evaluating ourselves. And as I told you, we have one of the largest product lines that any company has. Okay, if you benchmark ourselves, there's only one company in the world who has such a wide product range that we have. And we have, they don't do marine business.
Fair.
Okay. So what I'm trying to tell you is that we have everything under the sun which is available with us. It is up to date and it is the most modern. So there is nothing that we need to acquire from someone. As a matter of fact, if we acquire even a European company, we can give them know-how.
Fantastic. Sir, last question, please indulge me. assuming that in the next 2-3 years time, the business grows to 2,000 crores, is there a chance at all that your assembly line is rusty because you're not used to that scale of operations?
See, it may be that we may have to change it, but today we have the potential to design it ourselves and to take care of those requirements.
Fair. Wonderful to hear your comments, sir. Thanks and very best wishes.
Thank you.
Thank you. We'll now hand it over to the management for closing comments. Over to you, sir.
Thank you. First of all, I need to thank all of you for showing a large amount of interest in the company. All I can tell you is that we are on the path of recovery. What has been stopping us from achieving in the past, we have been able to overcome that. The inflow of orders have been healthy. Our team is geared up to produce and meet with the targets on a monthly and on a quarterly basis. Apart from that, we believe that as soon as we are able to reduce and restructure the debt, the profits would be further accumulating and we would be able to show even better results. So the material handling problems that were there, we are able to slowly and gradually overcome those. And now I can say that hardly a small amount, or let's say a small part of the tail is left out before it goes out of the door. So almost everything is taken care of. And we see a very healthy and a good future. So thank you all. And I wish you have a pleasant day today. Thank you.
Thank you. Thank you, everyone.
Thank you all.
Thank you.